embracing the highly competitive layer, one world. Hey, welcome back to Mr. Suw Crypto's channel, where we discuss the world of crypto from the basics to the more complex topics over a cup of coffee. Today, we're going to talk about something that gets asked a lot. Bro, how do you know which layer one networks are actually growing and which ones are just hyped up on Twitter? Well, you know how it is in the crypto world, especially the layer one sector. The competition is brutal. It's like a street-side eatery where everyone's competing to serve the tastiest menu, but the customers are always the same. Ethereum, Solana, Avalanche, Sway, Aptos, and the newer ones, all vying for attention from users, developers, investors, and speculators. Amid all the hype and FOMO swirling around every day, as investors, we can't just rely on instinct or blindly follow the crowd. We need to analyze data, understand trends, and look for indicators that signal, okay, this network isn't just cool in branding, but also solid fundamentally. So, in this episode, I'll take you through how to determine whether a layer one network is truly growing or just passing through. We'll discuss 4 aspects: on-chain volume, number of developers, active users, and the number of partnerships they have. We'll break it down one by one, casually but seriously, using data and logic. Because if we just rely on narratives, we might end up being the exit liquidity for a project that leaves us behind. Get your coffee ready, grab your notebook, and let's dive into the first topic: on-chain volume. Chapter 1: On-chain volume, the lifeblood of an ecosystem. All right, let's start with the first indicator that's easiest to access but often overlooked: on-chain volume. Imagine you run a coffee shop. Your shop has a cool design, an expensive espresso machine, and an Instagram account with tens of thousands of followers. But the question is, how many people actually buy coffee every day? That's what on-chain volume is for a blockchain. On-chain volume can be the most honest indicator of whether there's real activity within the network. Is real money being used, transferred, staked, swapped, or even just moved between wallets? All of this can be seen if you know how to read it. Tools you can use? Try opening DeFi Llama, Dune Analytics, Nansen, or Token Terminal. These are free tools. Some have premium versions, but even the free ones are enough to provide valuable insights. There, you can see total value locked, TVL, daily volume, unique transactions, the number of active wallets, and protocol growth day by day. For example, you can compare Ethereum's established TVL with that of newer networks like Sway or Linea. If TVL keeps rising, it means more people are trusting the platform to lock their assets there. But if it drops, well, there might be issues with trust, user experience, or even projects leaving one by one. But don't misinterpret: a high TVL doesn't necessarily mean it's healthy. Sometimes, just 1 or 2 big projects can cause TVL to spike. But once those projects leave, TVL plummets. That's why it's also important to look at the distribution. Are there many projects contributing to TVL, or just a few? Example: if 80% of TVL is concentrated in just one DeFi protocol, that indicates insufficient diversification. But if there are 20 to 30 protocols with healthy volume, that's a sign the ecosystem is developing more balanced. Don't forget about wash trading. Be cautious of fake volume, also known as wash trading. This often occurs on newly launched chains. They offer significant incentives for farming or test nets, but once the incentives end, the volume plummets. So don't just look at the big numbers. Also consider sustainability. Is the volume consistently increasing? Is there a correlation with the number of unique users? Or is it just the result of an airdrop? Signs of a healthy ecosystem. Volume increases slowly but steadily, not like the volatile ups and downs of altcoin pump and dump schemes. The number of contributing protocols is growing. Active user activity is also increasing. We'll discuss this further in Chapter 3. Developers are more active in updating. We'll cover this in Chapter 2. So, if you're researching a layer one project and want to know if it's growing, on-chain volume is the first thing you must look at. It's like the heartbeat of the ecosystem. If the heartbeat is strong and stable, it means the network is alive and moving. But if it's flat, don't be surprised if it eventually dies. I mean, if it eventually loses value. All right, that's it for Chapter 1. If you found this insightful, get ready for Chapter 2 because we'll be talking about developers, the builders of the blockchain. They're the ones who determine whether a network will last or just be a seasonal project. Alright, let's continue. Chapter 2. Developers, the builders of the Layer 1 ecosystem. Alright, now let's talk about developers. No matter how advanced blockchain technology is, if no one develops, maintains, and innovates it, it will eventually stagnate. It's like having a sports car, but never servicing it. Eventually, it will break down. In the Layer 1 world, developers are the lifeblood that keeps the ecosystem alive. They're the ones creating smart contracts, building dApps, fixing bugs, upgrading protocols, and basically making everything work. Without them, the project would become a museum piece. Cool, but no one cares. Why is the number of developers so important? Because the number of developers allows us to measure two important things. 1. How attractive the network is to build on. 2. How strong the technical community is for long-term sustainability. Take Ethereum, for example. One reason it's still the Layer 1 king today isn't just because it was the first, but because its developer community is huge and highly active. There are always updates, proposals, improvements, and even new standards like ERC 20, ERC 721, and so on. How to check developer activity? Don't worry, you don't have to check GitHub one by one while counting commits. You can use platforms like Electric Capital Developer Report. They release an annual report on the number of developers per chain. Artemis.xyz or Token Terminal. They have daily or monthly data on active developers. CryptoMiso for tracking rankings based on GitHub commits. From there, you can see, for example, the number of active developers weekly/monthly, the number of new contributors. Are there a lot of commits, but only from one account? Or is it truly a community? Many developers is not equal to thriving ecosystem? This is an interesting point. Sometimes there are chains with many developers, but no actual products in use. So we can't judge solely by numbers. We also need to consider quality and consistency. Do these developers stay in the ecosystem long-term? Do they participate in hackathons, launch projects, create DAOs? Or are they just using the platform for testing to secure grants? Beware of projects that often hire developers. There are also projects that seem active, but their developers are temporary freelancers. You can check this in the GitHub report. If all commits come from new accounts every month, it might not be a community, but outsourcing. Signs of a developer-friendly Layer 1. Solid SDK support, like Cosmos with SUSM. Clear and up-to-date documentation. Regular hackathons. Developer grant programs. Active developer tools and infrastructure, RPC, nodes, explorers, etc. Examples? Polygon and Solana are among the most active in organizing developer events and global hackathons. Some even offer incentives and mentorship to create open-source projects within their ecosystems. Why is this important for investors? Because developers are a long-term indicator. If you're aiming for quick profits, volume and sentiment may be sufficient. But if you're playing the medium to long-term, especially if you plan to fund solar power plants with crypto proceeds, the number of developers and their quality are crucial. They will determine future innovation, adoption, and project stability. The key phrase, sustainable innovation. So, when you research Layer 1 and see claims like, we have 1,000 dApps, take a step back and ask, who built them? Are they still active now? Are there new projects? Or has developer activity died down? If all the answers are positive, then you can say, okay, this network isn't just about branding, but also about actual development. This chapter is done, bro. We've covered the blockchain builders. Now it's time to talk about who comes to the building every day, the active users. Because without users, developers and on-chain volume are all for nothing. Chapter 3. Active users. Proof that blockchain is actually being used, not just a gimmick. Now, we've talked about the heartbeat of blockchain, on-chain volume, and the engineers behind the scenes, developers. But there is still one thing that determines the life and death of a network: active users. Yes, users. Because no matter how advanced the technology, how well-written the code, or how large the volume on the charts, if no one is using it, it's all just for show. Who are active users? Simply put, these are the people who actually use the network. They might just swap tokens, open a dApp, play an NFT game, stake tokens, or even just log into their wallet every day. But their presence makes the network function and hold value. You've probably seen projects that were initially super viral, with their tokens skyrocketing and hundreds of thousands of Twitter followers, but a few months later, it's quiet. Why? Because users moved elsewhere. Whether it's due to high gas fees, a bad UI, slowness, or just initial FOMO. How to check active user data? Well, you can check active user data from various sources. Artemis.xyz and Token Terminal offer daily/weekly data on unique users. DeFi Llama and Dune Analytics have dedicated dashboards that you can filter by protocol. Nansen, premium, but if you have access, the data is very comprehensive. Official network explorers like Etherscan, Solscan, Sway Explorer, etc. Pay attention to these metrics. Daily active addresses, DA, unique wallets active in a day. Daily transactions. More transactions equals more active network. Retention rate. Do users come back or not? This can be seen from addresses that consistently remain active week after week. New wallets created, the more signups, the higher the likelihood of adoption. But be careful, don't be fooled by raw numbers. Sometimes a network may appear to have 500,000 transactions per day, but 80% of them are just bot farming or airdrop hunters. So it's crucial to also check if the activity is diverse. For example, multiple dApps are being used, not just one. There's a thriving DeFi, NFT, and GameFi ecosystem. There's activity from real user wallets, not just new wallets every day. A user-friendly blockchain equals user loyalty. This is a cliché, but it's true. A blockchain that's comfortable, fast, and cheap will make people reluctant to switch to another platform. Solana, for example, despite occasional downtime, its improving UI/UX and near-zero gas fees keep users loyal. Or take Base. Though new, its direct integration with Coinbase and seamless user experience have led to a steady increase in active users. On the other hand, slow, complicated, expensive, and error-prone networks usually only see a brief surge during token launches, then get abandoned like an ex who ghosted us in high school. Why is this relevant for investors? Because active users are the foundation of all value. They are the ones who use the token. They are the ones who keep the protocol running. And they are also the ones providing liquidity on DEXs or showing interest in buying NFTs. If loyal users keep growing and becoming more active, it's a strong signal that the ecosystem is truly thriving. And for you as an investor, it means the project is worth monitoring more closely. It could be a strategic spot to average in, or even take a bigger position if you're confident. Signs of organic growth in Layer 1. The number of active users is steadily increasing, not just during events or airdrops. Activity is widespread, not just from one protocol. There are many new wallets, but also many loyal ones. User retention is good. The community is active on social media, Discord, or forums. And one more thing, projects with healthy active users typically find it easier to form a flywheel effect. More users, more developers, more products, even more users. All right, that's the deal with active users, the backbone of the Layer 1 ecosystem. Now we move on to the final chapter, partnerships and strategic collaborations. Because in the crypto world, no one can succeed alone. Everyone needs allies. Chapter 4, Partnership. Who are blockchain's partners? Okay, now let's discuss the last, but no less important part, partnership. In the real world, you would agree that people who have many connections usually survive better, especially if the connections are not just acquaintances, but mutual help and support. Well, the same thing applies in the crypto world, especially for Layer 1. Because the fact is, no blockchain network can survive on its own. It's impossible. No matter how advanced the technology is, if it doesn't have a strong network of relationships, whether with other projects, institutions, developers, exchanges, or even governments, it will struggle to grow. Why are partnerships so important? Because partnerships are a sign that the network is trusted by others, is expanding its adoption, receives support from a larger ecosystem. Here's a simple example. Imagine there are two Layer 1 projects. One regularly announces new collaborations every month, wallet integrations, partnerships with major DeFi protocols, listings on CXs, collaborations with Web3 games, etc. The other, well, it just posts memes and motivational quotes on Twitter every day. Where would you invest? Types of relevant partnerships. To avoid being swayed by marketing alone, you need to be able to distinguish between types of partnerships. 1. Technology integration. For example, a Layer 1 network integrated by MetaMask, Ledger, Trust Wallet, Chainlink, the Graph, etc. This is important because it makes the ecosystem more accessible. 2. DeFi and NFT ecosystem. Is this network the primary choice for DeFi/NFT project launches? For example, are there active DEXs, lending protocols, or NFT marketplaces built on top of it? 3. Exchange listing and custodian support. Is the Layer 1 token supported by major centralized exchanges, Binance, Coinbase, OKX? Or can it be stored in a hardware wallet? 4. Collaborations with games, DAOs, or other projects. The more integrations into the GameFi, DAO, and other worlds, the greater the long-term potential. 5. Corporate/institutional partnerships. For example, collaborations with large companies, local governments, or educational institutions. This typically validates credibility, though it's rarely discussed. How to check if a partnership is genuine or just a gimmick. You've probably seen blockchain project tweets like, "We are thrilled to announce our partnership with XYZ." But upon checking, it turns out to be just a giveaway collaboration with an influencer. That's a partnership gimmick. To avoid being deceived, you can check. Does the partnership impact usage? Is there technical integration, or is it just a promotional stunt? Has the partner also announced the same thing? Does this collaboration expand the network's utility? If the answer to all of these is yes, then the partnership is legitimate. But if it's one-sided and filled with empty promises, you should be suspicious. Where can you monitor new partnerships? You can monitor them from the project's official Twitter/X. Check announcements and reposts from its partners as well. Medium blog for technical details or collaboration explanations. Discord and Telegram to listen to community discussions about new updates. Messari and Token Terminal for strategic partnership updates and product launches. And one additional tip, don't just focus on the number of partnerships, but on their quality. It's better to have one active major partner than 10 passive minor partners. Examples of partnerships that boost Layer 1 value. Polygon collaborated with Disney, Starbucks, and Reddit, resulting in a significant number of NFTs and loyalty systems moving to Polygon. Avalanche partnered with Amazon Web Services, AWS, enabling enterprises to deploy subnets quickly. Solana entered the mobile space with Solana Mobile, partnering with various startups for crypto-native app integration. Sway and Aptus have been pursuing integration with gaming studios from the start for GameFi expansion. Notice the pattern above? Good partnerships are strategic and long-term, not just about gaining new followers. What does this mean for investors? Because partnerships are leading indicators of adoption. They come before TVL increases, active users grow, or token prices surge. So if you can detect these signals early, you can secure a strategic position before the market fully realizes it. If Chain suddenly partners with PayPal, or Network B integrates into a national banking system, or a major platform like Uniswap migrates part of its operations to a specific network, that's a major signal. All right, we've covered the 4 key indicators for identifying which Layer 1 networks have the potential to emerge as winners. Let's move on to the conclusion and our 5 rules, which have been refreshed but retain their original meaning. Continuing. Layer 1 isn't just a big name, but real data. Well, bro, after talking at length about how to recognize a Layer 1 network that is truly growing, hopefully you'll become more discerning and not easily fooled by hype alone. Because there are so many projects that look great on the surface, nice logos, funny tweets, cool branding, even big influencers endorsing them. But when you dig deeper, they're empty. Like a luxurious house that's just a facade. No activity, no users, no developers, no partnerships, just relying on marketing noise. Meanwhile, a truly strong network is usually evident from the 4 indicators we discussed earlier. 1. Continuous growth in on-chain volume and activity. 2. An increasing number of active developers. 3. Loyal, active users who stay and keep using the platform. 4. Relevant, solid partnerships with real impact. Remember, Layer 1 isn't just a stage. It's the foundation. If the foundation is weak, everything built on top of it, from DeFi, NFTs, to GameFi, can easily collapse. But if the foundation is strong, everything built on top of it has the potential for sustainable growth. So if you're serious about being a medium or long-term investor, don't just ask, will the price go up? Instead, start asking, is the ecosystem being used more? Is the team continuing to develop? Are users becoming more engaged? And who else trusts and collaborates with them? Only then will your decisions be more rational, free from FOMO, and you'll feel more confident taking action. Because you're not just following the trend. You understand why you're in and when it's time to exit. And as usual, before we wrap up, here's the latest version of 5 Important Rules of Mr. Suw Crypto, Layer 1 Hunter Edition. 1. Data first, FOMO later. Always look for data before jumping on the hype. If Layer 1 is really good, the data will speak for itself. 2. Understand before buying. Don't just go with it's fast, it's cheap, or it's widely used. You need to understand why that's the case. 3. Look at activity, not hype. A roadmap can be ambitious, but what matters most is what's happening on-chain right now. 4. Adoption needs an ecosystem. A Layer 1 without developers, users, and partners is like a mall without tenants. Big, but empty. 5. Timing is everything. Sometimes a Layer 1 is good, but it's not the right time yet. Don't rush. Patience equals safety. That's all for today's episode. If you gained insights from this discussion, help me share it with your friends who still chase quick rising tokens without knowing anything about the underlying network. Subscribe to this channel, leave a comment, and as always, do your own research. Because it's your money, it's your responsibility. See you in the next episode, only on Mr. Suw Crypto Podcast. Stay sharp, stay curious, and always invest with purpose.